Okay students, so welcome to the last part of the revision lecture, revision of full portion of CA final direct tax in 100% English language. We have been proceeding, as you are aware, in the order of our textbook. Now we have entered volume 3 and the last chapter where we have stopped is income from house property. Very few chapters left and this is going to be the last and final part of your revision lecture. Let's come to a very important chapter, charging section 28, must do chapter, because 14 marks question you can expect. Profits and gains of business or profession. As we are aware, in this chapter the main trick is going to be to do your computation, that is the add less no effect part properly. You have to focus on the solving part as much as you do on the provision part. So very quickly let us revise. How are we going to start? Net profit as per profit and loss account. We will make one add side which will have one income point, one expense point, one less side, one income point, one expense point, and then we will have our PGBP. So we have 2 points on the add side. What are the 2 points? Expenses debited but disallowed, and incomes which are taxable but not credited. And on the less side we have 2 points. Again, one income, one expense. Income which are credited but not taxable, maybe exempt income, maybe other hand, and expenses which are allowed but not debited. So the whole problem of PGBP chapter is that the act will teach us only allowed and disallowed expenses. If we have studied the expenses which are allowed and disallowed, it means that we have studied the chapter profits and gains of business or profession as far as the act is concerned. But the sum solving starts from there. You have to go and see every amount what assessee has done in accounts. The treatment in your computation is strictly going to depend on what assessee has done in accounts. If the treatment in accounts is correct, then you don't have to do anything. If it is wrong, you will either add or less. Every add less no effect, you get marks. Every wrong add less low effect, you lose marks. And thus every amount in the question we will ask 3 questions. First, whether you are income or expense. That's a very easy question. Second question will depend on income or expense. For expense it will be debited or not debited. That is accounts, that question will give you. For income it will be credited or not credited, question will give you. For income, third question will be taxable, not taxable. With common sense, if it is related to business, taxable, otherwise not taxable. But for expense it will be allowed or disallowed, and that is what we have to learn. If any student does not know the quantum of allowed or disallowed expense, you are unfit for the exam. You have got zero sympathy from me. I don't love you, I am sorry, but you don't deserve any kind of love and affection. I feel sorry and sad only for those students who have learned allowed disallowed expenses properly but are not able to get marks because you have not done your add less no effect part properly. As far as your act is concerned, allowed expenses section 30, rent, rate, taxes, repairs and insurance for building. 31, repairs and insurance, plant and machinery and furniture, both sections used for the purpose of business or profession, main condition. Section 32, the biggest section, depreciation, owned and used for the purpose of business. Then you will get depreciation on tangible as well as intangible asset, but no depreciation on land and no depreciation on imported motor car between 75 and 2001. Under income tax, WDV method, block asset method is going to be compulsory. Accounts, you can do anything. For tax, we will disallow that and calculate separately. As per accounts, we will add back, and as per tax, we will be subtracting. That is what we are aware of as far as our depreciation deduction is concerned. More than 10,000 should be account pay check, account pay draft, electronic mode including bank and other prescribed. Same amendment will apply here also. And if it is amalgamation, then it will be a portion in the basis of number of days. Only power generation, only tangible optional basis they can use SLM method also, and manufacturers will get additional depreciation. Power generation calculation is very easy. Take depreciation at the rate fixed amount every year because it is SLM. However, if the asset is sold, then there will be twist. If selling price is below the WDV, it will become terminal depreciation deduction. If it is more than the WDV, up to original cost, it will be PGBP. More than original cost, it will be capital gain. If we talk about block asset method, all assets will lose identity once they enter the block. As long as the block is in existence, we will not calculate any capital gain or capital loss. Capital gain or loss will be calculated only when the block ceases to exist. That is when everything is sold or selected assets are sold at a higher price. Otherwise, depreciation will be adjusted in the amount of, otherwise profit or loss will be adjusted in the amount of depreciation. The ready-made blocks are given, respective rates are given, you have to abide by that. Additional depreciation for manufacturers, 20% of the cost in the year of installation, and in 4 backward states, Andhra Pradesh, Bihar, Telangana, West Bengal, it will become 35%. Half rate concept will apply year also and normal also. Purchased during the year and used for less than 180 days, then that depreciation will be half. But remember, if it is purchased during the year and not used at all, no depreciation, because It is not used only. And next year, even if you use it for less than 180 days, it won't be covered under half rate because it is not purchased during the year. It has to be purchased during the year and used for less than 180 days for half rate concept to apply. Other conditions for additional depreciation, only manufacturer, only plant and machinery, and second hand is not going to be allowed. If we understand this, then 32 AD is almost over. Same conditions except that the investment in plant and machinery should be in backward state. 15% of the cost in the year of installation you will be getting your deduction, and half rate concept is not going to be applicable over here. Half rate applies only under section 32, that is normal depreciation and additional depreciation. Half rate concept is not going to be applicable. 32 AD always you will have to less. Then there are some small sections, 35 ABB, 35 ABA, spectrum, fish, telecom license. I'm not revising. You can take it on payment basis on the remaining estimated life. You can take it. I'll revise section 35 with you. Important section, scientific research. First 35.11 and 35.2. Capital or revenue for own business scientific research, 100% deduction of current year, and pre-commencement last 3 years. However, pre-commencement will not include perquisite to employees. Revenue expenses, you have to get it certified from prescribed authority, and capital expenditure, you won't get any other deduction and no deduction on the cost of land. Then we have contribution to approved college, association, university, institution. For scientific research, 150%, statistical research, 100%, and if it is national laboratory, IIT, again scientific research, 150%. Indian company doing in-house scientific research and development, 150% of all capital revenue expenditure. But land not available and building you won't get 150, but you can take 100, and if you have given a contribution to such company, then 100% deduction of such contribution will also be available. But if you are taking this deduction, company will not get 35 to AB deduction. After this, another important section was section 35A, D, 14 specified businesses. If you invest in them, 100% deduction of capital expenditure, including pre-commencement without any time limit, but you won't get any other deduction. No deduction on the cost of land, goodwill, financial instrument, because it has to be a new business, not splitting up or reconstruction of an existing business. Second hand local plant and machinery can be maximum 20%, not more than that. For the same business, you cannot take 10 AA and 35 AD both. Same assessee for different business can take it. 3 points about set of chapter. Only against loss can be adjusted only against specified business profit. Unlimited carry forward, and ROI has to be filed on time. And obviously the 14 specified businesses you can just read through here also. If more than 10,000, then account pay check, account pay draft, electronic clearing modes, bank account or other prescribed modes rule is going to be applicable. Then there are some other small sections of allowed expenses, which even if you go through plain and simple manner, you will understand all that is happening out here. Under disallowances, 37(2)B, political party 100% disallowed, whether cash or check, PGBP disallowed. And if it's other than cash, if it is other than cash, then in chapter 6A you can still take your deduction. Then if we talk about 40 small a, one is going to be TDS related. If pay is resident, 30%. If pay is non-resident, then 100%. But if paid in future year, allowed in that year. So current year you will add, future year you will less. All types of direct taxes are also going to be disallowed, including interest on direct taxes. That is also 40A. And the third part you can leave also over here, state government undertaking 1, you can leave that because that is not so important. 40B and BA we already cover in partnership form chapter. 40A subsection 2, excessive payments to related parties, excess will be disallowed, not the entire payment. 40A subsection 3, same person same day more than 10,000, then 3 allowable modes. Here again that amendment has taken place. 3 allowable modes you can make payment, otherwise your expense is going to be 100% disallowed. And also go through rule 6DD, exceptions wherein you can make payment more than the limit in a disallowed mode and still the disallowance is not going to be invoked. So 40A subsection 3. As far as 40A 7, 9, 11 are concerned, contribution to approved employee benefit funds will be allowed in 36(1) and unapproved will be disallowed. But approved only if paid, because 43 is applicable, and unapproved also if paid it will be allowed. So ultimately paid basis it will be allowed, but for approved funds, because it is 43B, we get time up to due date of return filing. This brings us actually to 43B. Certain deductions will be allowed only if you make payment. You can make that payment till 139(1) due date. If they are unpaid, they will be disallowed. What are those payments? All kinds of indirect taxes, payment for usage of railway assets, bonus and commission to employees. So salary not covered and commission to agent not covered. Bonus and commission to employees, leave encashment to employees, and approved employee benefit funds. Only if paid up to due date of return filing will be allowed. And last two were about interest. Public financial institution, scheduled bank, cooperative bank. Only if paid, interest will be allowed, otherwise interest is going to be disallowed. And if you pay in a future year, it will be allowed in that year. So current year we will add in computation, that year we will less in computation. After which we have general rules and regulations about maintenance of books of accounts 44AA, separate rules for specified profession and for everybody else separate, tax audit, business 1 crore, profession 50 lakh rupees, presumptive taxation 44 AD you can take up to 2 crore. So you can still escape from tax audit, but if it is optional, so if you don't opt for it, then 1 crore is only applicable limit. ADA is for professionals 50% and AD is for business 8% of your turnover. This will be PGBP. But if turnover is achieved in the 3 allowable modes, again that amendment prescribed electronic modes, then if it is achieved up to due date of filing return, instead of 8% you can offer 6% as PGBP. That's your 44 AD and ADA. AE is for transporter light vehicle 7,500 per month or part per truck, and heavy vehicle 1,000 per ton per month or part per truck on the basis of ownership, not on the basis of usage. And the last 4 sections were presumptive taxation of non-residents. 44B is for shipping companies and BBA was for airline company. Shipping business 7.5% of turnover, airline business 5% of your turnover. Turnover will include everything paid in India, and if journey starts from India, even if it is paid outside. So turnover will include 2 things. Journey commencing from India, everything will be included, and payment made in India, irrespective of journey, it will be included. So origin is important and payment is important. Destination is not important. And handling, demurrage charges, etc. will be included. And if we talk about 44BB and BBB, extraction and exploration relating services, and BBB was turnkey project in civil construction, 10% of your turnover in both cases. These are non-resident related sections. And mind you, if we opt for these provisions, then MAT also is not going to be applicable. That was our chapter, profits and gains of business or profession. You have to put extreme focus on the add less no effect part. Let's go ahead, next chapter, capital gains, capital asset taxable transfer. If both will take place, then only capital gain will arise. Otherwise, capital gain will not arise only, it is not exempt. Capital asset has inclusions everything, but exclusions you have to focus. Stock in trade, gold deposit bonds, special bearer bonds, gold bond issued from time to time, rural agricultural land and personal movable assets. But in personal movable assets, we have exception. Sculpture, artwork, drawing, archaeological collection, painting and jewelry. Taxable transfer will include sale, exchange, relinquishment, extinguishment, compulsory acquisition, conversion of capital asset into stock in trade. Under compulsory acquisition, we will do detailed discussion. Capital gain is taxable. First installment received and full cost of full amount will be taxable, full cost will be adjusted. Full cost. So your subsequent installments will not be taxable. But if you are getting enhanced compensation will be taxable in the year of final order, cost already taken, so 0. Only litigation expenses will be allowed as a deduction. And interest will be obviously under IFOS. Let's talk about conversion of capital asset into stock in trade. FMV on the date of conversion will be selling price for capital gain, and it will mark end of your holding period and indexation. Though tax will be paid in the year of sale of stock, it will mark end of indexation. Likewise in compulsory acquisition also, capital gain arises in the year of compulsory acquisition. Though we pay tax on receipt basis, capital gain has already arisen in the year of compulsory acquisition, and therefore indexation is going to stop. In the year of sale of stock, there will be PGBP as well as capital gain. The FMV on the date of conversion will become selling price in capital gain and cost price in PGBP. And if the same transaction happens other way around, stock in trade converted into capital asset, same rule will apply. This time FMV will become selling price in PGBP and cost price in capital gain, eligible for indexation or entering into block asset. If it is depreciable asset, then it will enter the block, and this will mark start of your holding period. That was our compulsory acquisition, conversion of capital asset into stock in trade. When capital and asset and taxable transfer both take place, then we go to computation. Gross sale consideration is amount received. In 50C and 50CA, AO can question the amount received. What were the special cases? Barter or exchange. FMV of the asset received. Asset destroyed, compensation if received, then only taxable transfer, otherwise not a taxable transfer. In case of conversion, FMV on the date of conversion. Transfer of capital asset by partner to firm, value recorded in books of accounts, firm to partner, then fair market value. Compulsory acquisition, the compensation or the enhanced compensation. In case of joint development agreement, stamp duty value of the property received plus the money received in cash. In case of liquidation, the FMV of the asset received minus deemed dividend, because on that much amount the company has already paid tax. And if it cannot be determined, then in that case, also let me discuss 50C, then we'll go to the last point. 50C, actual or stamp duty value, whichever is higher. Actual or stamp duty value, whichever is higher. But what are the facilities? Facility 1, you can call for VO. He will compute a value between the two. Facility 2, you are allowed 5% variation on your actual price. Actual amount into 5%. If your stamp duty value is falling within that much range, then also it will be allowed. Third facility, you can take agreement date stamp duty value also. However, for that some amount has to be received at the time of agreement in the 3 allowable modes, again that amendment. And the same rule will apply for 43 CA if the immovable property is stock in trade. And then next section 50 CA was sale of unlisted shares, actual selling price or fair market value, whichever is higher. But here they have an amendment that we will notify exceptions where this section not applicable. And if selling price cannot be determined, then in that case, what are we going to do? Take FMV of the asset transferred. As far as transfer expense concerned, normal your brokerage etc. will be allowed as a deduction. Cost of acquisition is the amount incurred for ownership, eligible for indexation if it is long term, except 7 cases where you don't get indexation. Index cost of acquisition will be COA, CII multiplied by transfer year divided by acquisition year. Cost to the previous owner, holding period also will be added. Indexation, Act says current owner, Bombay High Court Manjula Shah says take indexation also from the previous owner. FMV option, if the asset was acquired before 1401, then you can take actual cost or FMV, whichever is higher, in fact available for bonus shares also. Then the other points, right shares etc. you can go through, very easy points. In special cases of cost of acquisition are given, where cost of acquisition will not be easily available, you can go through. In that, pay special attention to slump sale, advance money forfeited, slump sale, advance money forfeited, you should pay special attention to them. Slump sale, advance money forfeited, you should pay special attention to them. Then improvement cost, if there is cost incurred for increasing selling price, then improvement cost will also be available. And then we have been given certain exemptions, as we are aware. Again, selling price of our asset, if we utilize that money for investing in another asset, then we are allowed to utilize it. We are allowed to utilize that amount invested as our exemption. Are we clear? Next chapter, income from other sources. Anything which does not get included anywhere else will be included here. The two big concepts of this chapter are dividend, which we discuss in our DDT chapter, and the gift part, gift taxable for all assessees, selected assets. For the receiver, it should be capital asset, then only it will be taxable. Still, we have some exemptions. On the occasion of marriage, gift received from relative, death, will, inheritance, shares allotted at the time of amalgamation or demerger, anything received from a trust or educational medical institution. And here also there is an amendment, any notified. Here there is relative definition which you can go through. For every gift you get 50,000 limit. Cash gift you get total 50,000 limit. Movable property for inadequate consideration, total for the year you get 50,000 limit. For no consideration you get 50,000 limit. And for immovable property, for inadequate as well as no consideration, you get 50,000 limit for every transaction. 50,000. If the stamp duty value and actual amount paid difference is more than 50,000 per transaction, then there is going to be no taxability. That's our gift part. And in this also you have the facility of agreement date stamp duty value. This time the advance has to be paid in one of the 3 allowable modes. And here also you have the facility of 5% margin. If the difference is up to 5% margin, then there is going to be no tax liability. So 50,000 was already there and 5% also. So tax will arise only if the difference is more than 50,000 as well as 5%. It should be more than the both, or you can say more than higher of the two. Automatically it will be more than both of them. And that section 56 to 7b also, private company issuing shares to resident more than face value, that is premium, and more than fair market value also. Then the issue price excess over FMV, not the entire issue price, but excess over FMV will be taxable. 56 to 7b, yes, securities premium is getting taxed. That was our last head of income, that is income from other sources. That was our last head of income from other sources. Let's go ahead. Clubbing of income. Whenever you are trying to show income of somebody in the hands of somebody else, that income will be included. Certain transactions are specified. Section 60 to 64. Minor child is a very famous example, very small chapter, you can go through it. Set off and carry forward of losses. First step inter source, next step inter head, and only the balance will be carried forward. Let's go loss by loss. Salary, no loss. House property, first inter source, you can adjust anywhere peacefully, no restriction. But if you want to do inter head, first of all maximum 2 lakhs, otherwise you will have to carry forward, and that also not allowed against casual winnings. House property loss not allowed against casual winning. Then you can carry forward up to 8 years even if you file your return late, but adjust only against house property. Let's go to PGBP losses. PGBP, speculation loss only against speculation business. If you don't have, carry forward for 4 years, file ROI on time and only against speculation. Specified loss only against specified business. If you don't have specified business, direct carry forward. Unlimited period, but file ROI on time only against specified. And other losses, you can adjust against speculation specified or any other profit. If you don't have, then you can go to other heads also. That is, except salary and casual winnings, you can go everywhere. Or carry forward for 8 years, file ROI on time and adjust against PGBP during those 8 years. Capital losses. Short-term loss can be adjusted against short-term gain, long-term gain both, but long-term loss only against long-term gains. If you don't have, there is no interhead possible, directly carry forward. 8 years, file ROI on time and 8 years you can adjust again. Short-term loss against any capital gain, but long-term loss only against long-term capital gain. Under IFOS, casual losses will immediately lapse. OMRH losses only against OMRH profits, otherwise carry forward for 4 years. Carry forward for 4 years. Only against OMRH, ROI has to be filed on time. And other losses under IFOS, you should do inter, source, but you can't do that against casual winnings. Then interhead you can do against any income, but there is no carry forward facility available. So give first preference to this. And as far as your UAD is concerned, that is different from entire PGBP loss. We will segregate UAD. UAD can be adjusted against any income except salary and casual winnings. In fact, if you file your ROI late also, then also it can be carried forward. ROI can be filed late for house property and unabsorbed depreciation, unlimited carry forward, and unlimited you can adjust against anywhere again except salary and casual winnings. This is how we will do set off and carry forward of our losses. For old syllabus, we enter into our last chapter, that is deductions under chapter 6A. There are expense related deduction in which you should put a little focus on 80C, D. So those sections can be tested in your any sum like NRI taxation, DTSS sum. You need to focus on that. Obviously there are maximum limits, there are certain rules and regulations. Income related deduction, 80 IAC startup, 80 JJAA, 80 IBA, there are certain deductions on which you have to focus. And TTA, TTB is day to day life deduction, so you can go through that also. Deductions, individual quantum you will have to learn in deductions chapter. Also let me tell you about two newly introduced section, 80 EEA for home loan interest. If it is your first house, first preference you will take SOP. And after SOP, if there is some unutilized amount up to a maximum of 1,50,000 you can take here. Already there was 80 EE, but for that loan should be taken during 16-17. But now loan taken during 19-20 will be eligible under EEA. Here the value of property should be maximum 45 lakh. They have not given any amount of restriction on the amount of loan, but obviously it will be much lower than 45 lakh. Automatically it will come under a restriction. Again a newly introduced section, 80 EEB. Loan taken for purchase of electric vehicle. Government wants to promote that. So actual interest or 1,50,000, whichever is lower, will be allowed as a deduction. And this loan can be taken from 1st April 19 up to 31st March 23. So after you become a CA in a couple of years, if you have money, you can spend money for electric vehicle. You will get this concession of tax deduction of 1,50,000 under 80 EEB. Actual interest or 1,50,000, whichever is lower. Under your 80 IBA also some amendments have taken place, where we had metro cities Mumbai, Chennai, Delhi, Kolkata. Over there we are adding Bangalore, Hyderabad. With Delhi we are adding the entire national capital region like Noida, Faridabad, Gurugram, Ghaziabad, Greater Noida. And with Mumbai we are adding the entire Mumbai metropolitan region. The towns on the outskirts of Mumbai, but they fall in the Mumbai metropolitan region. The land area of 1,000 and 2,000 square meter restriction is unchanged, but the plots, but the individual house size, which was 30 square meter for maximum 30 square meter for metro cities and 60 for non-metro, is now changed from 30 and 60 to 60 and 90 respectively. That means in metro cities you can construct up to 60 square meter houses and in non-metro up to 90 square meter. But all this will be applicable if the project is approved after 1st September. On or after 1st September. Existing project, existing rule will apply. And on or after 1st September, any project approved, the stamp duty value of the house should not be more than 45 lakhs. These are some important sections. 80 IAC and JJAA. Please do properly. This was your deductions under chapter 6A, and this was the last part of our old syllabus. Old syllabus revision gets over here. As far as new syllabus students are concerned, they know that they have 3 extra chapters. Base erosion, profit shifting. About OECD action plans. Every plan has got the problem, the recommendation, and the Indian taxation change. The Indian taxation change, whether equalization levy or 115 BBD or BBAF or 94B or 286, all the sections we study somewhere or the other. Tax treaties, application and interpretation, about how to interpret treaties, where more focus should be on Vienna Convention on the law of treaties. And model tax convention, about comparison between OECD model and UN model. In all these 3 chapters, at least the questions which are given behind the textbook, you should learn only that much. Once you have learned the questions behind the textbook, one of them will come and it will be easily manageable if you have studied. These were the 3 extra chapters applicable for new syllabus students. And with this is the end of the revision lecture, revision of full portion of CA final direct tax in 100% English language. Thank you very, very much for this power pack. I wanted to keep the duration short, so I may have been fast at a few occasions, but the objective is that you can revise well. If you want detailed explanation, we have full courses. As a professor, I recommend that what a full course can do, no other course can do. This revision lecture was meant only for those students who have already studied the full course, preferably with me, then this was a worthy lecture for you. Thank you very much. End of your lecture. Thank you so much.